Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And in today's video, we're going to do a follow-up on some of my new favorite products out there, new ETFs, which are very, very unique. They're income-oriented. Of course, I'm talking about the Purpose Yield Share ETFs. They have a Tesla one, an Amazon one, a Google one, etc. So in today's video, we're actually going to do a little follow-up on some of them because I think it's a great time because there's a lot of tech companies like Tesla, like Amazon, like Google that will be releasing their earnings this month in July. So it's a very exciting time. And as we know, these yield share ETFs are a great way to get access to these non-dividend paying companies to get some income off of them, right? Instead of just buying low and selling high, these yield shares are a great way to actually get access to some of your favorite tech stocks, but get high monthly income along the way while you wait. For example, the Google one, the Amazon one, they're both hovering about 8% yield, and the Tesla one is hovering about 12% yield. So I'm not gonna do a deep dive into these ETFs and how they work because I've already done that in a previous video. So I strongly suggest you check it out. I even talked to the fund manager, Nick Murch, all about these. And guess what? Nick Murch is back. So I'm very lucky to get him back, and we're gonna talk about a little bit about the big tech earnings that are coming up, what to look for. We'll focus a little bit on Tesla, Amazon, and Google. And another very interesting thing that I'm excited to talk to him about is how the yield shares ETFs are actually been performing, because they've been out for over 6 months now, and I think the data will surprise you. Believe it or not, some of them are actually outperforming the underlying. That's right. If you would own some of these yield share ETFs, you would actually have been better off or have higher total returns than actually owning the single individual stock, believe it or not, regardless of not only the management fee, but also the very, very high skyrocketing prices recently. So a lot of people say, covered call strategies always underperform the underlying. Well, it's not the case anymore. That narrative is gone. So, well, let's talk to Nick Murch. Very excited for this conversation. I'll also ask him a very common and important question I get all the time. What happens when these covered calls are actually exercised? So let's talk, Nick, about these the upcoming tech earnings season. Let's talk to them about yield shares, purpose yield share ETFs, and how they've been performing. And of course, what happens when these covered calls are actually exercised. Let's get to it. Hey everyone, welcome back. So Nick, our returning champion, thanks so much for coming back on the channel. Really, really appreciate it. Can't think of a better person to talk to with all, this great tech rally that we've been seeing. And there's actually a lot of tech earnings coming up. So let's start with that right away. Well, actually, first of all, how are you doing, my friend?
Thanks for having me back on. Doing really well and trying to navigate this sort of year-to-date run here. And I think it's been fascinating and caught a lot of people offside. So really just trying to get down to what's going on here and where we can go from here.
Yeah, the stock charts are incredible. I mean, you look at Amazon or Google or Tesla, you just see like a rocket ship going up. It's like, wow, what is going on? How high can it go, right? So, yeah, let's start with that. So, the big tech earnings are coming shortly, actually. And we've had a
Mhm.
pretty crazy, ride to the year with these crazy bull runs and rocket ships going up in terms of the stock prices. So, what do you make
Yeah.
of this? I mean, you're an expert here, portfolio manager at Purpose. What do you think is going on with this recent tech rally for some of these big cap tech stocks?
Yeah, and I think, as you had mentioned, it's pretty alarming to see some of these year-to-date performance numbers. And that's why I think this earnings period coming up is going to be an extremely pivotal one for the overall market, and particularly the tech stocks as well. And if you look at the performance on a year-to-date for the Nasdaq 100, this has been the best year. First half of the year since the 1980s. So it's no secret that a lot of these technology stocks have really been on a tear. However, if you break down a lot of these stock prices, you have to remember they're made up of two components. So the sentimental and the fundamental. So the sentimental component is the earnings multiple that these companies trade at, and are really made up of narratives and growth expectations for the future returns. Whereas the fundamental side is things like earnings, revenue growth, and EBITDA margins. And if we look at the fundamental side, What we're seeing now is a slowdown on the revenue growth figures and a lot of deceleration on this front, and some of these, which is ultimately affecting a lot of the company's earnings period. But at the same time, on the sentimental side of the equation, we have rapid multiple expansion that's fueling a lot of the year-to-date performance so far. And a lot of this is just all driven on the back of a narrative. And narrative drives a lot of these stock prices, and the narrative behind a story can really take hold and really make these companies explode on a year-to-date basis. And the narrative that's really driving a lot of these in the early parts of the year here is artificial intelligence. And I think that AI will be an incredibly disruptive force going forward. But these sea change movements in the overall market, these take time, and they take time to work their way through the market. A lot of these expectations are really being pulled forward, and we don't just yet know how this evolves. And at the same time, if you think about the macro backdrop, we really are in an opposite condition compared to back in the sort of 2021 and 2022 periods, where we had this massive injection of capital into the system and extremely accommodative monetary policy. We're now in the exact sort of opposite macro condition when you look at monetary policy. So we have rates that are still high, really trying to put a lid on inflation still. We have a lot of quantitative tightening coming that's resuming after sort of we saw through this bank crisis. And at the same time, if you look at these tech stocks, they're really in that party on mode still. So a lot of people are left scratching their head saying, okay, a lot of this is fueled by a lot of hype into the system, but where do we go from here? And I think that if you looked at the beginning of the year, a lot of people's playbooks had recession in them, and they had get really defensive in the first half of the year because we're going to see some recession coming here. And Mr. Market does what he does best to just prove to everybody wrong. So a lot of people are trying to think, okay, where can we go from here? And I think one of the only certainties right now is that it's going to be choppy, it's going to be volatile, it's going to be really interesting. And that's where I think a lot of these yield share products can really help in, because what we can do is get in front of that and really help farm a lot of that volatility in order to generate yield, and then really smooth out those return profiles of the underlyings.
Yeah, I love what you said about Mr. Market. Trying to predict Mr. Market usually never ends up well. So yeah, talking about those yield shares, this is a great way to get access to some of these big tech names with a lot smoother and lower volatility. So can you just give us I know we talked about this in the previous video, we had a whole video on them, but can you give us a quick recap of, what these ETFs are and how they should be used or viewed?
Yeah, absolutely. So purpose yield shares are really constructed to provide exposure to the long-term return profile of key individual stocks while maximizing monthly yield in the portfolio. And so the way that we think about this is earning rent while housing your favorite security holdings. And so what we do is we introduce a mix of moderate leverage on top of a call writing strategy. And the performance of the product broadly mimics the performance of the underlying while providing yield in a tax-efficient manner. So this product really does complement investors' single stock holdings by shifting either a portion or all of that holding in this ETF product, as you can generate yield while capturing a lot of that upside still. So in terms of how exactly it works, the way that we break it down is each single yield share has three components. So the first is the outright purchase of the underlying security, which is then hedged back to Canadian dollars using forward contract. So the investor doesn't need to worry about hedging away currency risk within this exposure. The second is that it then adds 25% leverage to that underlying security. And the third component is that 50% covered call writing strategy between at the money and 5% out of the money calls. So what we end up here is by only underwriting against 50% of the NAV into the options, we've got a healthy mix of yield that we can generate while also having the ability to participate on the upside of these stocks through appreciation of the underlying. Whereas if you have a fully covered call strategy, yeah, there might be some fancy yield on the brochure in terms of that attractive rate that you're collecting, but you're giving away too much of the upside is what we found. So here we're finding that mix where you can generate a lot of the yield, but then also participate in the long-term upside of these securities.
Yeah, I think that's a great explanation. The way I look at it, it's a very convenient way and an income style way of owning the stocks that you really like. And another thing, these are all Canadian listed. You buy them in Canadian dollars. You don't have to worry about, buying Amazon or Google in USD and doing the conversion. That's such a big problem for some people. So very, very convenient. And the proof is in the pudding, because it's been, over 6 months now. And one of the main concerns I always got on my channel, especially with covered call products, is they're always going to underperform the underlying. This is not exactly the case with yield shares. As of now, a lot of them are actually beating the underlying. So you, for example, what does that mean? I'm sorry about the banging, by the way. There's renovations going on. If you hear that, but what that means is that you'll be better. You would have been better off, for example, owning the Amazon yield share versus the actual Amazon stock if you factor in the income total return. And I just want to share my screen here. That's right. So we can actually see how the proof is in the pudding. So you see the Amazon one here. Since inception, they all came out in about December of 2022. These five here, and this is the performance as of end of June. And you see the Amazon one, total return 61 versus Amazon stock at 53. Even the Apple one is a bit higher. So the Tesla one underperformed a little bit, which is kind of normal because Tesla was just on a rocket ship. But you have the Google one kind of on pretty much neck and neck, Burke neck and neck. So it seems to me like you guys actually found a really good formula: 25% leverage, up to 50% coverage. So are you surprised by this?
No, not at all, really. And I think that when you go out and you build these products, it's nice to kind of have a back testing and test it in theory. But the problem
Mm-hmm.
with back testing is you're always fitting your data to sort of outcomes that you require. But what we said and what we wanted to show the market is say, hey, let us put us into practice and then watch our performance. We're going to be able to do this on performance. And the product is doing exactly what we built, we came out to do and how we built it. And it's even exceeding a lot of these expectations. So we're outperforming a lot of the underlyings when you compare it to the CDRs. And the reason why we compare to the CDRs is just it hedges away the currency component. So any fluctuations in currency, it's a little bit more of an apples to apples comparison. And what we're doing is we're really outperforming on nearly all the names. And if there's a little bit more of an updated one in terms of that graph, and it's a little bit better on the Google or Berkshire, but you're right, those two are more or less in line, with Amazon and Apple outperforming and then Tesla underperforming. So if you think about just sort of Tesla, a lot of this was due to the path dependency during this bull run. And if you look at the trading of kind of Tesla's stock at our product launch, what you have in terms of the price action is one of those worst case scenarios when you write calls with a runaway bull market, because what you're doing here is you're getting called away very frequently to the upside. However, if you look at a pure covered call strategy on Tesla, they would be drastically underperforming the underlying, whereas we're still capturing about 80% of the upside in the performance aspect of it, even in the face of this rip away bull market on the stock. So we still kept up with performance. And I think that speaks to the total return aspect that is really built into this product, because we are still participating on the upside. In the case of the Berkshire, only slight outperformance here is that if you look at kind of Berkshire, it has a little bit more of dampened volatility around the near term. So it is slightly tougher to pick up yield when you're having that call writing strategy. However, what we're still doing here is adding a solid income component to this name. And I find it interesting that when you think about Buffett himself, he loves these dividend type paying stocks and these free cash flow generative companies, yet doesn't pay a dividend himself on his stock. So it's an interesting component to really add some income to your portfolio while keeping that exposure. So a great way to really bolster the yield on that position. And in the case of the Apple, Amazon, Google, the yield shares product is really performing well. And on all three of these, despite this massive year-to-date rally, you think, okay, Tesla had this rip away rally, but those names also did too. So shouldn't you be underperforming there? But that wasn't the case at all. So what we saw here was a more steady and gradual kind of up to the right movement with these prices, which is exactly the wheelhouse of the yield shares product. And what this allowed us to do is capture a lot of that upside movement while really writing call options forward, where we picked up a lot more yield versus the opportunity cost of getting called away. So because we were able to so efficiently farm that yield, the negative components of a covered call strategy, we were able to overcome because our yield exceeded that component of getting called away. And I think this really speaks well to our proprietary option strategy, which I do want to mention right now. So our in-house option strategy is a systematic approach where we have 50% of the NAV in written calls at any time. And we average between at the money and 5% out of the money calls. But we do have a band around these levels because we're very cognizant of trading costs and we're watching this every day. And at any given time, we'll have around 10 to 12 sort of legs of different options expiries from 1 to 6 weeks out. And what this does is really limit the path dependency of the underlying security around those single dates. And we know now, especially in the current day market conditions, the market's very reflexive around these key dates, whether it's the CPI or the FOMC or earnings periods days. We use these varied legs to really remove some of that path dependency risk over super short periods of time. And what this allows is our yields to be generated that we are generating to be smoothed out over a given period. So we've had great success in terms of the performance year to date. And I think at the end of the day, the performance really tells the story. And the product is doing exactly what we intended it to do.
Yeah, I mean, I was very impressed when I saw the graph. It's very, very rare that I ever see a covered call product outperform the underlying, especially in a bull environment. But like you said, with the 25% leverage, that proprietary covered call strategy, obviously you guys have found a really nice formula, which is very, very impressive. And, the management fee, I have to mention, is actually very low as well. So even with that management fee, for some of these are outperforming, management fee of 40 basis points, 0.40. Very impressive. I think you guys really found a really nice formula. So I hope we continue with that success. Now, one question I have all the time, when it comes to covered calls and people who are a bit newer and trying to understand what the covered call strategy is, what actually happens? Maybe you could help us with this. I can't think of a better person to ask. When calls get exercised, like what actually happens? What is the process? Do you guys wait to buy the stock back? Can you maybe quickly explain the process of what happens when the stocks are called away?
Yeah, that's right. So if the options are exercised and called away, about 50% of the underlying, up to 50% would be forced to sell at that strike. But the product will still have 75% of exposure to the upside on top of capturing that increase between the cost and the strike price. But also remember that we have many legs underwritten at any given time. So the percentage of underlying that gets called away at any one given date is not that 50%. So the 50% is the portion of the overall NAV that is a covered call. But because we have so many different legs and so many different expiries, it works out to any individual date getting called away closer to 5 to 10% of it. And if the stock is getting called away, we then have the proceeds because we are forced to sell. And then the proceeds from that sale are invested back into the underlying on the same day. And the covered call strategy and leverage portions, so that mix of the two, are then rebalanced and adjusted accordingly, all on the same day that the stock gets called away. So we're dynamically rebalancing around the expiry dates as they come to maturity. And if the position is in the money and we're forced to sell, then we sell that position and reinvest the proceeds.
Seems like you guys know exactly what you're doing. You have a system, which exactly what I want to hear from my covered call manager, and it seems to be working. So now going back to the earnings, can you speak to about the upcoming earnings more broadly, and really how your yield share products are positioned for the upcoming big tech earnings coming up?
Yeah, absolutely. And what we have into this earnings period, I think, is going to be a really just high bar to beat. Since a lot of these stock price performances year to date has been multiple expansion, we need to have the fundamentals hold up really in order to maintain these higher stock prices. And I think if you go back, the narrative over 2022, just thinking about the tech sector specifically, was that a lot of these tech stocks were perceived to not really have the operating leverage that everyone thought they did over 2022. And it was a tough earnings period for these tech stocks because what we saw was revenue deceleration, but also weaker bottom lines. So the bull case over 2022 is that tech companies might see slower revenue growth, but they have flexible cost structures so they can cut some expenses in order to protect that bottom line. In 2022, this was categorically false and really not the case. So we had slowing earnings and a lot of companies that missed. They really got punished in an oversized way to the downside if you missed it all. Now, if you fast forward to 2023, we're starting to see a lot of that operating leverage actually come through. So we got a lot of the headlines about job cuts at these major tech companies, and this really didn't show through to a lot of the income statements of the mega caps until the sort of end of 2022, early 2023 period. So what needs to happen here is we need to see that the revenue side, the deceleration on the revenue side is a little bit better than feared. And we need to see more optimized cost structures when it comes to these tech companies. Because I think the old mantra of technology was move fast and break things. And now it's sort of crawl slow and fix things. And operating margins and profitability metrics matter now more than ever, especially as you have a higher rate environment that pulls forward a lot more duration. And it'll also be interesting to try to line up the picture with a lot of this macroeconomic data that's telling us, well, maybe we're not in for a recession now, and cross-referencing that with earnings, which is the real sort of boots on the ground type of economy readings that we can see at these companies. And a lot of sort of recessionistas, I guess we'll call them, are really walking back their calls. And we're seeing a lot of the possibility that this fabled soft landing might actually be possible. So some of those predictions are coming out. And I don't really have a crystal ball, I think, is the bottom line here over the earnings period. But I do think we're going to see some fireworks. And it's going to be some pretty interesting kind of trends here. And Yield Shares really loves fireworks because we can really more optimally write calls along different parts of the implied volatility ladders when it comes to our option strategy. And that's a way that we can really differentiate by capturing those implied volatility movements within that option trading strategy.
Yeah, I love that you said fables. I typically never listen to predictions and things like that because it never turns out to be right usually anyway. And you know, how can you, I mean, Google, Amazon, Apple, I mean, these are monsters, and it's almost like I don't
Hmm.
even think of them, this is my personal opinion, I don't really think of them as hyper growth companies anymore. It's more like they're
That's right.
essentials now. It's crazy. So
Hmm.
can you maybe give us, you know, maybe two or three companies as examples in coming up for the earnings, and what we should pay attention to with those three?
Yeah, absolutely. So I'll start with Tesla just because that's one where the options market is particularly exciting, and there's really a lot of volume there. And there's also a lot of speculation around the stock as well. And we know how it's a favorite in the retail sector. We know it trades at sky high multiples. We know that when you compare the units shipped to other OEMs, that it doesn't quite stack up. But what I'm paying very close attention here to is the profitability conversion that we're really seeing at Tesla and how the unit economics are evolving. And when you look at sort of the legacy OEMs like Ford, they have EBITDA margins in sort of that high single digits. GM is closer to the 10 to 15% range, whereas Tesla is currently in the 15 to 20% range. And in 2022, that number was closer to north of 25%. And on top of that, it's got a lot more growth than the incumbents. But what you need to pay attention here too is a lot of the consumer demand patterns that we're seeing, and Tesla's recent sort of pull back at when it comes to their pricing models. You really have to start paying attention to that. How much longer can people buy $60,000 to $80,000 cars for? Was the Model 3 really that affordable? I know up in Canada, for sure here wasn't. If you look at some of the pricing points there, and when we've got a recession possibility coming up, you might have to pay attention to wallet share there too. So we know that there's mass electrification of transportation. We know that Tesla's at the forefront, incredibly innovative, but we also have to pay attention to how the unit economics are evolving and just what kind of competition starts to enter the market here. To me, it wasn't real, the competition, up until lately. So we'll see what's going on there. So the three things I would look for are unit volume improvements, profitability scaling out, and a return to stronger revenue growth. And you'd mentioned just sort of these companies as reflection of the real economy versus the hyper growth side of it. So I'll mention Amazon. And I think for Amazon, you have to think really as two separate businesses. So the first is that product side, where if you forget to grab toothpaste at the grocery store, you fire up the app and you have it delivered to yourself the next day. And you can do it all from your couch, no problem. And when you look at the major sort of ETF baskets, Amazon's really bucketed into that consumer discretionary pile because of their dominance in this product marketplace. And on this side, you look at the strength of sales when it comes to kind of building out their partner network and how the growth is trending there. And then on this side of the business, again, it's very important to look at the kind of cost structures. So what everyone pays attention to on the product side at Amazon is the operating margin part of the business, the operating income. And this goes back to the mantra that I talked about before. These companies need to drastically control margins really in order to show that they're a lot more immune to any macroeconomic downturns that might come. So the most important thing to watch over at Amazon is going to be that operating income line. And when it comes to the other part of the business, you have to pay attention to any sort of deceleration on the AWS, their cloud company side. So last quarter, we actually got one of the steepest decelerations when it comes to AWS, with the growth rate down to around 20% versus the previous quarter growth of 27%. And the quarters back in 2017 and 2019 were north of 40%. So you've got a really big revenue deceleration. And I think what a lot of it is just AWS really not only running into macro headwinds, but also just the law of large numbers sort of kind of theory. Whereas if you just have such a massive base, eventually the growth, of course, is going to slow. And I think that speaks to exactly what you're talking about in terms of a lot of these companies being a little bit more mature in their revenue growth profiles. So again, it's going to be about flipping that down to the bottom line, improving profitability. Just one other one to quickly mention is on the Google front. And I think Google is a great sort of proxy when you think about ad spend and the health of business budgets when it comes to the direct marketing dollars that a lot of the ad executives are being handled here. So most of Google's revenue comes from that search. And for a while, there was a pretty interesting period where we had this massive panic over whether ChatGPT would replace search. And we're seeing a lot of data on sort of the increased users and web traffic volume on the ChatGPT front. But what we're also seeing is that Google's search business isn't going anywhere yet. So don't forget, Google is really instrumental in the base technology that a lot of these new AI products use. They've been working in this area for a very long time. They've also got that YouTube component, which is a little bit more insulated from this sort of AI hype cycle. And it's really been a staple in the portfolio for the last while. And YouTube is just an absolute beast. So if you think about just overall the ad spend at Google, you kind of think of it as a canary in a coal mine when it comes to assessing the health of all the small businesses, small and large, because companies will pull back drastically on their ad campaigns whenever they see softening demand. demand patterns. And this is going to show up in the earnings period here. So going to be very excited in terms of what comes out here over the next couple of weeks. And it's sort of the finance world Super Bowl every time you have either an FOMC meeting or some of these earnings periods. And it's great to kind of dissect the numbers and try to figure out what it means. So going to be really exciting times.
Yeah, it really is. I mean, all three of the companies you mentioned, thanks for that. It's really, really cool updates on those. All three stand to benefit greatly from AI, right? The advancements of AI, Google and Amazon. And another thing with Amazon, you mentioned AWS. I remember that from my tech days, and everyone thinks, you buy something on Amazon. They have different stuff. They actually have, technology companies that are buying their AWS services, and then Tesla as well, which, even Kathy Woods talked about, she got a lot of criticism because she sold her NVIDIA. But then a lot of people don't realize, and even Elon Musk testified this, they're very, very, very advanced in the AI as well when it comes to self-driving. So all the three of these companies could definitely benefit from that. So it is very exciting time. So Nick, I just want to thank you for, enlightening us and talking about this. Do you have any final thoughts before we drop off here?
Yeah, absolutely. And I think that with all that's going on, and especially in the sort of technology stock world, there's going to be more volatility ahead of us. And we had a period here where if you look at the implied volatility on the individual names, it has been relatively muted. But I think after the torrid pace that these companies have been on a year-to-date basis, we're in for a bumpy ride ahead. And what yield shares allows you to do is, again, collect rent while you're housing those favorite securities. And we're thinking now is a great time to sort of become that landlord, to be able to collect the rent and be able to print that coupon while really maintaining the exposure to the underlying security and healthily participating to the upside. So we think this upcoming earnings period is going to be a great opportunity to switch into yield shares.
Yeah, and volatility is good for option premiums. And like you said, it's better to
That's
be,
right.
I'd rather be a long-term buy and hold landlord than a house flipper. Because with these stocks, pretty much none of them give dividends. Not even the Burke one doesn't. So you have to, everyone says, oh yeah, my Tesla stock, then they don't sell it. I hear it all the time. Then it'll crash 40%. With the yield shares, you'll get that stock price moving, but at least you're getting paid that great yield every month. Same with the Google, the Amazon. So it's, this is just my opinion. It's a safer, more volatile way, less volatile way to own the underlying. You get paid every month. You don't really have to worry so much, when do I sell and this and that. So you just collect your rent, like you said. Great analogy. So Nick, thanks again. And good luck managing these great products. So far, so great. Actually, the numbers speak for themselves. It's very rare that a cover call product, not only you're beating some of the underlying, but even the ones that are not, it's not like you're that far off, which is what I want to see. So phenomenal success so far, and can't wait for the next ones. We'll probably have you on again when the next set come out. I know that there might be a Microsoft one coming out. I know you can't talk about that, but just more great big cap tech companies to own and get paid while you're waiting. So thanks again, Nick, and we'll talk to you soon.
Thanks so much. Really appreciate it. Take care.
Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or companion or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.